Welcome to the deep dive. Okay, so you shared that Motley Fool article with us, the one called Two No-Brainer Warren Buffett Stocks to Buy Right Now.
Oh, right. I remember that one. Amazon and Mastercard, wasn't it?
Exactly, and it really caught our eye. So for this session, we thought we'd, try to get under the hood of that analysis.
Sounds good. Figure out why the article tags them as no-brainers, especially since they're in Buffett's Berkshire Hathaway portfolio.
Precisely. We want to unpack why now seems like the compelling time, according to them.
Well, the article does make a point about Berkshire's history, doesn't it? They're known for finding these durable companies.
Mm-hmm. And that portfolio size they mentioned, $271 billion. When they make a move or hold something significant, people notice.
For sure. A portfolio that big, any conviction pick is definitely worth exploring.
Right.
So where should we start? Amazon.
Yeah, let's dive into Amazon first. The article mentions its history of monster returns, which, everyone knows.
Right. But Berkshire's timing was interesting. They only started buying in 2019, relatively speaking.
Yeah, late in the game, kind of. Holding 10 million shares by the end of 2024.
So what's the no-brainer argument now?
Well, okay, so e-commerce was the foundation, obviously. But the big shift, and what the Motley Fool piece really hammers home, is how much of the business isn't just online shopping anymore.
Ah, you mean like AWS, advertising?
Exactly. Amazon Web Services, cloud computing, advertising, their third-party fulfillment. These now make up most of the business, apparently.
And they're more profitable too, right, than just straight retail?
Generally, yes. Higher margins in those service areas. That's a key part of the thesis, I think.
Okay, that's a pretty fundamental shift then. And AWS, it's huge. The article put its market share at over 30%.
Yeah, of a $330 billion cloud market, according to Synergy research figures they cited, that's real dominance.
Dominance in a field that's just, well, it's still exploding, isn't it? Especially with AI demanding so much compute power.
Absolutely. And that connects directly to the AI boom. AWS is kind of foundational for a lot of that development.
So Amazon's positioned right in the middle of that whole trend. And the article points out AWS revenue grew 18% in 2024. That's $107.6 billion annually.
Wow. Which is, 17% of Amazon's total revenue from just AWS?
Yeah, it's a massive chunk. Yeah, growing fast. Hard to ignore that kind of momentum.
It really shows how they've become like infrastructure for the modern economy, both businesses and, us.
And on the consumer side, the article brings up Alexa, right?
Yeah.
All those devices.
Over 600 million of them, yeah. How does that play into the no-brainer idea?
Well, the thinking is, as AI gets better, Alexa could make shopping even easier, more intuitive. Just talk to order things,
Ah, okay. So strengthening their grip on retail through AI integration.
Pretty much. It deepens that integration into people's lives, both retail customers and the enterprise clients using AWS. It's a powerful ecosystem.
Makes sense. Convenience is sticky. Okay, and the last piece on Amazon was valuation, trading at 16 times cash from operations per share.
Right. And the key point there was that this is apparently the lowest that metric has been in over 10 years for Amazon.
So why is that seen as a good thing? Just means it's cheaper relative to the cash it's generating.
Basically, yes. Price to cash flow is a way to look at value.
Okay.
A lower multiple, especially for a company with Amazon's growth areas like cloud and AI, could suggest it's, undervalued.
An attractive entry point, maybe, hinting at better potential returns if the market starts valuing that cash flow more highly again.
That seems to be the argument the article's making, yeah.
Okay, interesting. Let's switch gears then. The second pick, Mastercard.
Right. Different beast altogether. Financial processing.
Described as highly profitable, and the returns have been incredible, almost 500% over the last decade. Berkshire holds nearly 4 million shares.
Yeah, a long-term winner for sure.
So its business is processing payments, not lending money like a bank, right? What's the core no-brainer angle here?
Exactly. That distinction is crucial. They don't carry credit risk. They run the network, the rails that transactions ride on, and take a small fee.
Like a toll booth model.
Precisely. And because there are only a few major global players, Visa, Mastercard, maybe Amex, and Discover, to some extent, it's a very high-margin business. Less competition than you'd think at that scale.
And the article mentioned resilience, holding up well even when the market dipped. That makes sense if they're not exposed to defaults.
Their revenue is tied more to overall transaction volume, which tends to be steadier than, say, loan performance during downturns.
Gotcha. And the numbers are pretty staggering. $9.8 trillion processed last year.
Yeah, generating $28.2 billion in revenue, up 12%.
And profits look strong too. Net income up 15% to $12.9 billion. That's converting a lot of revenue straight to profit.
Very efficient, very profitable model. And the growth story isn't over.
Right, that was the other point. Despite being huge, with acceptance at 150 million locations, there's still a lot of cash out there.
A lot. The article estimated 1.5 trillion transactions are still done with cash and checks globally each year.
1.5 trillion, that's kind of mind-boggling.
It is. And every transaction that shifts from cash to digital is potential volume for networks like Mastercard. So that's the long-term growth runway. Huge potential still.
Okay, but what about the price? The article mentions it trades at 37 times earnings. That sounds high.
It does, on the surface.
Yeah.
A price-to-earnings ratio of 37 is definitely not cheap in a traditional sense.
So how does that fit the no-brainer label?
Well, the argument, as presented by the Motley Fool analysts, is that this kind of valuation is actually pretty typical for what they call elite growth stocks.
Meaning companies with strong competitive advantages, wide moats.
Exactly. Wide moats, long growth runways ahead. Investors are often willing to pay a premium for that kind of quality and expected future growth.
Because the expectation is that earnings will grow fast enough to justify the price.
That's the idea. And analysts, according to the article, expect Mastercard's earnings to grow about 14% annually in the coming years.
Okay, so 14% annual growth could support that higher multiple and still deliver good returns for investors over time.
That's the rationale presented, yes. Sustained growth justifying the premium PE.
So wrapping up the core arguments from the article, for Amazon, it's diversification into cloud and AI, that massive customer entrenchment, plus the valuation looking more attractive lately.
And for Mastercard, it's the resilient, high-margin toll booth business, the huge untapped market of cash-to-digital conversion, and that expectation of continued double-digit earnings growth.
Right. Two very different companies, but both presented as compelling based on those factors.
And I think for listeners thinking about that article you sent, it's valuable seeing these examples, how analysts or even Berkshire identify potential long-term strength in different sectors. E-commerce, cloud versus financial processing.
It shows there isn't just one way to find a strong investment, right?
Definitely. And it highlights that common thread maybe in Buffett's thinking: dominance, durability, growth potential, even across different industries.
It's a good point, too, that no-brainer sounds easy, but the analysis behind it, like in the article, involves digging into the business model, the market, the financials.
Absolutely. It's never really a no-brainer without understanding the why. You have to look under the surface.
So this look at the article, it gives us a clearer picture of why Amazon and Mastercard are framed this way right now, based on that specific analysis.
Indeed, a specific viewpoint, but backed by some clear reasoning around market position, growth, and financials.
Well, this has been a really insightful deep dive unpacking that Motley Fool piece on the two Buffett stocks. Lots to chew on.
Definitely interesting perspectives on both.
And maybe here's a final thought to leave our listeners with. We've talked about their current strengths, right? But think about how fast things change. E-commerce, cloud, AI, global payments.
The landscape is always shifting.
So how might Amazon and Mastercard need to adapt or innovate next to keep those competitive advantages sharp over, say, the next 10 years? Thinking about that future dynamic is always a useful exercise.